These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. Last week we started to look at the topic of enhanced allowances, and we'll stay with that topic this week as we examine the methodology for identifying the qualifying expenditure. I mentioned last time that the term enhanced capital allowances does not appear anywhere in the Capital Allowances Act. However, we do still need to turn to that Act to give us the statutory foundation for claiming these allowances. So, we're in Part 2 of the Act dealing with plant and machinery allowances, and Section 52 tells us when a person is entitled to a first-year allowance in respect of first-year qualifying expenditure. A table at that section shows us that allowances are available at 100%. In other words, a full deduction is given for the expenditure for the chargeable period in which the cost is incurred. Various types of such allowances are listed, including expenditure qualifying under Section 45A, i.e. expenditure on energy-saving plant or machinery, and expenditure qualifying under Section 45H, i.e. expenditure on environmentally beneficial plant or machinery. A slightly different approach is needed for each, so by way of example, let's take the environmentally beneficial category dealing with water-saving technologies. As we saw last week, the expenditure must be on new plant or machinery and must not be caught by any of the general exclusions for first-year allowances, nor may it be long-life asset expenditure. Two other conditions must be met when the expenditure is incurred or when the contract for the provision of the plant is entered into. The first is that the plant in question must be of a description specified by Treasury order, and the second is that it must meet environmental criteria specified by Treasury order for plant or machinery of that description. This leads us in turn to Statutory Instrument 2003/2076, as amended many times. To qualify for relief, the plant must in all cases fall within a technology class specified in what is called the Water Technology Criteria List, and it must meet the criteria set out in that list. In most cases, the asset must also be of a type specified in a second list, known as the Water Technology Product List. So the criteria list must be considered in all cases, and the product list in most cases. Finding these lists online can be tricky, but the easiest route is to go to the website of the Department for Environment, Food and Rural Affairs, which is www.gov.uk/DEFRA, and to search for water technology in the box at the top. For energy-saving allowances, go to the www.gov.uk site and search for energy-saving technology. Accountants and tax advisors dealing with capital allowances do, I suggest, need to have an understanding of these technical principles that underpin a claim for enhanced capital allowances. And it may well be their role to ensure that the allowances are claimed when it will be beneficial to do so, which will be in the context of refurbished or newly built property, including extensions. That will involve identifying the opportunity and asking the right questions, but the tax specialist or accountant can then leave it to the building professionals to advise on the specific assets that meet the qualifying criteria for claiming these enhanced capital allowances. Next week, we'll turn our attention to the topic of special rate expenditure, which covers more than just integral features and which has a few quirks that need to be watched out for. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.